Welcome back to the Deep Dive. I'm your host, and today we are doing something a little different.
Hmm.
We're pushing the boundaries of our usual format because, honestly, the story we're covering today just demands it. We aren't just looking at a stock ticker, we are looking at a survival story.
A turnaround story, really.
Exactly. We are turning the page to a special investigative edition we like to call Griffonomics.
Griffonomics. I love the sound of that. It sounds like a graduate seminar on how to analyze the impossible.
Right.
Or maybe a masterclass in high-stakes corporate maneuvering.
That is exactly the vibe we are going for. It does sound a bit academic, but trust me, the application is very, very real world. For all of you tuning in, let me just set the scene. Today is Friday, February 13, 2026.
Spooky.
A spooky date for some, perhaps, but for us, it's the perfect backdrop to talk about a company that has been through a literal house of horrors and, lived to tell the tale.
Yeah.
We are looking at a company that has been on a roller coaster ride that would make a theme park designer nauseous. We are talking about Evolv Technologies, ticker symbol EVLV.
Evolv is complicated. That's probably the best word for it. If you were looking at this company, say, 2 years ago, back in mid-2024, you probably saw it as a battleground stock.
Oh, for sure.
The bulls, they saw the future of physical security. A tech-first approach to a pretty dangerous world. But the bears saw a company that was drowning in hype, burning cash, and just completely wrapped in regulatory red tape.
Exactly. And the hook for today's deep dive isn't just that they make those cool security scanners you walk through at stadiums or theme parks.
No.
The hook is that this is a turnaround masterclass in the making. They survived a regulatory firestorm in 2024 and 2025, and we're talking Department of Justice, Federal Trade Commission, class action lawsuits that frankly should have killed a lesser company.
Most companies do not survive that trifecta. I mean, when the DOJ comes knocking, usually the equity goes to zero.
Right, it's over.
Or the company gets acquired for pennies on the dollar by a competitor who just wants the patents. Evolv didn't fold. They fought, they settled, and they are still here.
They are still here.
Yeah.
But here's the twist, and this is why we're calling this Griffonomics. Now that they've survived the lawyers, they are attempting a high-stakes business model pivot that, on the surface, it looks absolutely terrible.
It looks awful.
Their gross margins have crashed. Their accounting looks messy. But management is claiming that 2026, this year, right now, is the inflection point.
It's a classic case of optical ugliness masking structural beauty. If you only look at the headline numbers in a stock screener, you run away screaming. But if you look at the unit economics and the long-term strategy, you might just double down.
So our mission today is to generate a granular investigative report on this transformation. We're going to unpack why they switched from a distributor-led model to a direct purchase powerhouse. We're going to figure out if this inflection point is real or just, corporate speak.
Yeah, is it just jargon?
And we are going to look at the pain versus gain equation of their margin collapse.
And to do that, we've pulled a stack of sources that is honestly a bit intimidating. We have the Q3 2025 earnings call transcripts from back in November. We've got deep dive analysis from Seeking Alpha on the business model reset and the whole inflection point investment thesis.
Okay.
We've also got the full text of the DOJ and FTC settlements, which is not light reading. And we have raw customer data from major school districts and professional sports leagues.
It's a heavy lift, but that's why we're here. We chew the glass so you don't have to. Let's dive in.
Let's do it.
I want to start with the basics, the product. Because in the world of technology, financial engineering can only get you so far.
Right.
Eventually, the dog has to eat the dog food. If I walk into a stadium, say Gillette Stadium or Citi Field or maybe a Six Flags, I'm likely walking through an Evolv system that looks like two thick pillars with a gap in the middle. But for anyone who doesn't know, we need to be very clear. This is not a metal detector, right?
It is definitely not a metal detector. And that distinction is absolutely crucial because the physics are completely different.
Okay.
A traditional metal detector is, well, it's a dumb instrument. It works on electromagnetic induction. It creates a magnetic field. And if you walk through with metal, your keys, a belt buckle, a steel rod in your leg from a surgery,
It beeps.
it disrupts that field and the machine beeps. That's it.
It's binary. Metal equals beep.
Exactly. It doesn't know what the metal is. It just knows it's there.
Yeah.
That's why you have to empty your pockets. You have to divest. You have to take off your belt. That is, 20th century technology.
Right.
Evolv Express, which is their flagship product, uses what they call AI sensor fusion.
Sensor fusion, that sounds like marketing jargon or something out of an Iron Man movie. Break that down for us. What is actually fusing?
It does sound like it, but it's actually a legitimate engineering term.
Hmm.
The towers, they're just packed with multiple types of sensors.
Okay, like what?
You've got millimeter wave sensors, which you might know from airport scanners. You've got magnetic sensors, and you've got optical cameras. They capture data on the object's density, its size, its shape, and its composition all at the same time.
So it's not just is there metal, it's what does this metal look like?
Exactly. Instead of just beeping, that raw data from all those sensors is fed into a neural network, an AI that analyzes it in real time. The AI is asking, does this metal object look like a set of keys? Or does it look like the barrel on the slide of a Glock 19?
Wow.
Does it have the density of an IED? It creates a 3D threat vector. That is what allows people to just walk through at a natural pace, hands in pockets, phone in hand.
And the numbers on that are pretty staggering. We're talking about a throughput of, what, 4,000 people per hour?
4,000 people per hour, which is massive. If you've ever stood in a TSA line or even an old-school stadium line, you know the bottleneck is the divestiture taking stuff out of your pockets, out of your bag.
It's the worst part.
If you remove that step, the line just vanishes. And that throughput, that's the core economic value proposition for the venue.
But recently, in late 2024 and through 2025, they introduced a new piece of hardware that really kind of completes the picture.
Wow.
Because even if I can walk through fast, what happens if I have a backpack?
The back bottleneck, the great unsolved problem of venue entry.
I've been there so many times. I walk through the scanner, I'm fine. But then a security guard stops me and has to stick a wooden dowel into my backpack to check for. Honestly, I don't even know what they're looking for half the time.
It feels like security theater, doesn't it?
Totally.
The bag check just kills the flow. So Evolv launched Evolv Expedite. This is an autonomous AI bag screening system.
Autonomous meaning no human looking at a screen.
No human operator. It's not an X-ray where some guy sits in a dark room trying to interpret blurry images while, eating a sandwich.
Yeah.
You slide your bag into the Expedite unit. It sits right next to the express lanes, and it uses computer vision and AI density analysis to scan the bag. It gives a simple red light, green light decision.
That is a high-trust system. If the machine says green, the bag just goes in. No questions asked.
It is. And the early data from Q3 2025 is really fascinating. They showed a false alarm rate of roughly 2% on these bag scanners.
2%. That seems exceptionally low. How is that possible with all the junk people carry in the bags?
It's incredibly low, and you're right to be skeptical, but think about it from an operational perspective, like a high school at 7:55 a.m.
Chaos.
Absolute chaos. You have 2,000 kids trying to get to first period. If that machine beeps on 15% of the backpacks because of a heavy binder or a metal water bottle, the school goes into gridlock. You'd have a riot.
The system would be useless. They'd turn it off.
They would.
Yeah.
A 2% false alarm rate makes the technology viable for mass ingress. It solves the operational nightmare for the security director.
And the market seems to agree. I'm looking at the notes here. In Q3 2025 alone, 12 new customers bought Expedite, and 11 of them bundled it with the Express Towers.
It's becoming an ecosystem.
It really is.
That's the whole strategy. It's the Apple approach. The body scanner works better if you have the bag scanner, and they both feed data into the third piece of the puzzle, Evolv Insights, which is their software dashboard.
Let's touch on that software layer quickly. Evolv Insights. Because this is where the tech company valuation comes from, right?
Yeah.
They aren't just selling metal gates, they are selling data.
100%. Evolv Insights turns the entry gate into an operational intelligence node. It's not just security anymore.
What does that mean in practice? What can a venue manager see?
It tells them things like, hey, your north gate is seeing 20% more traffic than the south gate between 6:00 and 6:30 p.m. You need to redeploy staff. Or, we are seeing a spike in alarm rates at this entrance right after the first quarter ends. Let's adjust the sensitivity.
So it's proactive instead of reactive.
Precisely. It moves security from a reactive posture, waiting for something bad to happen, to a proactive, data-driven posture. You're managing the flow of people, not just searching them.
Okay, so the tech is slick. I get it. But in Silicon Valley, and really anywhere in tech, slick isn't enough. You need a moat. You need protection from 3 people in a garage cloning your product. What stops a competitor, say, a traditional defense contractor or a hungry startup, from building a sensor tower and writing some code?
That is the billion-dollar question, and it's why this isn't just a hardware story. Evolv relies on 2 very distinct moats. The first one is the data network effect.
Explain that. I hear that term a lot with software companies, but how does it apply to a physical scanner?
Think about how any AI learns. It needs data, lots and lots and lots of it.
Right.
The Evolv systems screen over 3 million people every single day.
3 million a day.
And since 2019, they have scanned over 3 billion people total.
3 billion with a B. That is a staggering number. I can't even picture it.
It is. And every time a scan happens, the system learns. Every time a security guard tags a false positive, say a new type of weirdly shaped umbrella that looked like a gun barrel to the AI.
Okay.
That data point is fed back into the cloud. The algorithm gets retrained. It learns, okay, that shape plus that density plus that location equals umbrella, not gun. The next time it sees that specific umbrella, it won't alarm.
So the system is getting smarter with every single person that walks through it across their entire network.
Precisely. Now, imagine you are a competitor entering the market today. You have 0 scans. Your AI is effectively an infant. It hasn't seen the millions of weird things people carry in their pockets.
Your false alarm rate would be through the roof.
Exactly. It would be unusable. You simply cannot replicate 3 billion scans of training data overnight. It's a massive empirical barrier to entry.
That makes sense. It's like trying to build a search engine to compete with Google today. You just don't have the decades of search history to make the results good.
It's the same principle.
But there is a second moat, one that I find even more interesting, because it's not technical, it's legal.
Yes. The golden ticket. The Department of Homeland Security Safety Act designation.
That's a mouthful. Break it down. What is the Safety Act and why does it matter so much?
It stands for Support Anti-Terrorism by Fostering Effective Technologies.
Yeah.
It was passed by Congress after 9/11. Basically, the government realized that companies wouldn't build anti-terror tech if they were terrified of getting sued into oblivion if an attack happened anyway.
So it's a liability shield.
It is a massive liability shield. Evolv holds the QAT designation, that's Qualified Anti-Terrorism Technology. If you are a customer, let's say you're the owner of the New England Patriots, and you use a QATT certified system, and God forbid there is a shooting or a bombing at your venue.
The lawyers come out instantly.
The lawyers come out in force. But because you use Safety Act technology, your liability is capped. In many cases, the lawsuit has to be filed against the federal government, not the venue or the manufacturer, and the damages are limited to the amount of insurance coverage required by the DHS.
Wow. So if I'm the general counsel for an NFL team or a major school district, and I'm choosing between Evolv, which has this shield, and Startup X, which doesn't, it's not even a choice.
It's professional negligence to choose the other guy.
Right.
That shield is incredibly difficult to get. It takes years of testing, data submission, and vetting by the Department of Homeland Security. Evolv has it. Most competitors don't. It makes them the safe choice for the C-suite, not just the security team.
Okay, so they have great tech, and they have a strong two-pronged moat.
Mm-hmm.
But we have to address the elephant in the room, or rather the elephant that just left the room, the regulatory firestorm.
Yes. You absolutely cannot tell the story of Evolv in 2026 without acknowledging the near-death experience of 2023 through 2025.
It was ugly. I remember reading the headlines. We had a Department of Justice investigation. We had an FTC inquiry. We had class action lawsuits flying around like confetti. The stock price got absolutely hammered.
It was the perfect storm of negative sentiment. And the core allegations, they really centered on 2 things: marketing claims and revenue recognition.
Let's take marketing first. What was the issue there?
There were reports, and these were heavily amplified by short sellers, that the system wasn't as effective as claimed, particularly against certain types of knives. There were accusations that Evolv had sort of overpromised on the AI's ability to detect every weapon every single time.
Which is an impossible standard for any technology.
Of course. But that was the narrative. And the revenue recognition issue.
That sounds more like an accounting problem.
It was. There were questions about how they booked sales. Were they counting sales to distributors as final sales to the company, even if the distributor hadn't sold the unit to an end user yet? It created this cloud of fear that the books were cooked.
So you've got questions about the product's efficacy and questions about the financials. That's a deadly combination for a public company.
It is. And for a while there, the 0 scenario, bankruptcy via litigation and massive fines, was a very real possibility. Investors were terrified.
They were. But, and this is why we're doing this deep dive today, that cloud has lifted. We are now in the post-storm era. Let's look at the scorecard from late 2025.
It's a clean sweep, really.
Walk us through the resolutions. Because if we're going to talk about an investment thesis now, we need to know that legal risk is off the table.
Okay, first, the big one, the Department of Justice. The investigation was officially closed in August 2025. The result? No charges.
Nothing.
They investigated, they looked at the files, they walked away.
Clean slate. That's huge. That alone must have caused a relief rally.
It did. Second, the FTC. The Federal Trade Commission inquiry into those marketing practices we mentioned, this was settled back in December 2024. The result? No monetary penalties.
$0 after all that noise.
$0. Evolv had to agree to certain marketing guardrails, basically being very precise in their language about what the system can and cannot detect, but financially it is a slap on the wrist.
Okay. And the last piece, the class action lawsuit. Usually these end in massive payouts that cripple a company's cash flow.
It settled for $15 million, which sounds like a lot. However, and this is the key part, Evolv had D&O insurance for this. The net cost to the company's balance sheet was approximately $1 million.
$1 million.
Yeah.
For a company doing over $140 million in revenue, that is a rounding error.
It is. So you have to think about the psychological shift for an investor. In 2024, you were asking, will this company even exist in 2 years?
Right. Am I going to zero?
Exactly. In 2026, that existential threat is gone. The lawyers have been paid. The government is satisfied. The company is no longer fighting for survival. They are now fighting for execution.
That legal clearance was the absolute prerequisite for the inflection point thesis we're analyzing today. If the DOJ was still lurking, none of the rest of this would matter.
Correct. The clearance is the foundation. Now we can finally build a house.
Which brings us to the meat of this episode, Griffonomics, the pivot, or as I like to call it, the great margin crash of 2025.
It does look dramatic on a chart. If you just pull up their gross margin line, it looks like it fell off a cliff.
Walk us through this transformation. Evolv used to sell through a distributor, a company called Columbia Tech. Now they sell directly. Why change a model that seemed to be working, and why did it completely wreck their margins?
To understand this, we have to put on our accountant hats for just a minute. It all comes down to the distinction between being an agent and being a principal in a transaction.
Okay, go on. I'm ready.
Under the old model, the distributor-led model, Evolv was an agent. They didn't physically touch the hardware inventory for a large portion of their sales. Columbia Tech held the inventory. When a customer bought a system, Columbia Tech shipped the metal towers.
And Evolv did what?
Evolv simply collected a license fee for the software and the intellectual property.
Okay, let me use an analogy. It's like if I wrote a book and a publisher printed it, stored it, and sold it. I just get a royalty check. I don't have to pay for the paper or the ink or the warehouse space.
That's a perfect analogy. So if the hardware costs, say, $50,000 to build, Columbia Tech paid that. Evolv didn't have that cost on their books. Evolv just gave a check for the software. And because software has almost zero cost to duplicate,
The margins are incredible.
Evolv's gross margins on that license fee were around 95%. It looked like pure profit.
95%? That sounds fantastic. Why on earth would you stop doing that? If I can get 95% margins, I'm staying in bed and counting my money.
It's a great question, and the answer is twofold: control and total dollars. Under that agent model, Evolv was only capturing about 70% of the total contract value.
So they were leaving 30% on the table for the distributor.
Exactly. The distributor took a healthy cut for handling the logistics and the inventory risk. Also, and maybe more importantly, Evolv had less control over the customer relationship. If a renewal came up, the distributor was the middleman.
So they were leaving money on the table, and they were flying blind on customer relationships. That's not ideal for a subscription business.
Not at all. So in 2025, they initiated the direct purchase subscription model. Now, Evolv is the principal. They fulfill the order, they take all the revenue, they own the customer relationship, and they take all the risk.
There's a catch, a very big margin-crushing catch.
The catch is the hardware cost. Now, when they sell a unit, they have to recognize the full cost of manufacturing that unit up front as cost of goods sold, or COGS.
So to go back to my book analogy,
Yeah.
Now I am self-publishing. I have to pay for the printing press and the paper and the shipping.
Yes, and that hardware has a real tangible cost. So in Q3 2025, their product gross margins collapsed to 14%, down from 95% the prior year.
14%. That is razor thin. If I saw that number without any context, I'd think the business was fundamentally broken.
It is terrifying if you don't know the backstory. But here is the Griffonomics logic. By taking that margin pain up front, by eating the cost of the hardware, they now capture 100% of the contract value. This drives significantly higher cash flow per unit over the life of the deal.
They were trading percentage points for absolute dollars.
Precisely. You can't pay salaries with margin percentages, you pay them with catch dollars. And more importantly, this entire pivot shifts the focus of the business to annual recurring revenue, AR.
And that's the holy grail for a tech company. The CEO, John Kedzierski, he calls 2026 the inflection point. What does he mean by that exactly? What's inflecting?
He is predicting that in 2026, the growth of their ARR will begin to outpace the growth of their total revenue.
Translate that for us. Why is ARR growth outpacing revenue growth a good thing? It sounds kind of counterintuitive.
It means the business is becoming stickier and more predictable. Total revenue can be lumpy. You sell a bunch of hardware one quarter, maybe a little less the next. It's transactional. But ARR is the steady heartbeat of subscription income.
The software fees.
The software fees, the service contracts, the data analytics subscriptions. If ARR is growing faster than total revenue, it means you are successfully building a massive base of high-margin, predictable software income that will pay you for years and years to come.
It's the classic SaaS software as a service transition. Adobe did this when they switched from selling Creative Suite boxes to the Creative Cloud subscription. Microsoft did it with Office 365.
Yeah.
It sucks for a year or two, the financials look messy, and then you become a money-printing machine.
It is the J-curve. You take a dip in profitability, or in this case, in margin percentage, to build a much more valuable, more resilient engine underneath. Evolv is deliberately pushing $5 to $10 million of potential upfront revenue out of 2026 to convert it into long-term ARR.
They're delaying gratification for a bigger payout down the road.
Exactly. They are telling Wall Street, don't look at the lumpy hardware sales from quarter to quarter. Look at the steady compounding growth of our subscription base.
And they're betting that the market will eventually value them like a software company, not a hardware company.
That's the whole game. Software companies get 10, 15, even 20 times revenue multiples. Hardware companies get maybe 2 or 3. It's a valuation arbitrage play.
That's the theory, a very compelling theory. But let's look at the reality. We have the Q3 2025 numbers right in front of us. Did the pivot work, or are they just bleeding out?
The numbers are promising, but they are definitely noisy. You have to squint a bit.
Okay.
Top-line revenue came in at $42.9 million. That's up 57% year over year.
57% growth is impressive for any company. That's a huge number.
It is, but we need to put a pretty big asterisk on it.
There's always an asterisk. I'm relying on you to find it.
About $7.5 million of that revenue came from what the company calls notable items. This is essentially accounting noise related to the business model transition booking revenue from legacy contracts that finally cleared through the new system.
So it's not really new business, it's old business finally getting counted.
Correct. If you normalize the growth, if you strip out that noise to look at the real organic growth rate, it's closer to 30%.
Okay, so 30% real growth. It's still very solid. It's not hyper growth, but it's healthy.
It is very healthy for a hardware-software hybrid company, but the number that I think really matters to investors right now isn't the top-line revenue, it's adjusted EBITDA.
Right. Earnings before interest, taxes, depreciation, and amortization. Basically, are they making money on an operating basis before all the non-cash charges?
Yes, and for Q3 2025, the answer was a definitive yes. Positive $5.1 million. That's a 12% margin on an adjusted EBITDA basis.
And this wasn't a one-time fluke, because a lot of companies can pull a rabbit out of a hat for one quarter.
No, it was their third consecutive quarter of positive adjusted EBITDA. This proves that the core business generates cash. They aren't burning furniture to keep the house warm anymore. The model works.
That's a huge milestone. Speaking of cash, let's talk liquidity. Because back in 2024, people were worried they'd run out of money to fight the legal battles and fund operations.
That fear is completely gone. They ended the third quarter with $56.2 million in cash on the balance sheet.
$56 million.
And on top of that, they secured a new credit facility for up to $75 million, with $45 million of that immediately available to them.
So they have access to roughly $100 million in liquidity if they need it?
Correct. And they guided to be cash flow positive in Q4 2025. That is the holy grail for a growth company. Once you are cash flow positive, you control your own destiny.
You don't need to go back to Wall Street with a tin cup.
You don't. You don't have to dilute your shareholders by issuing more stock, which is crucial because interest rates are still relatively high. You can fund your own growth.
They are operationally self-sufficient.
Yeah.
That just changes the risk profile completely. It's not a distress story anymore. It's a growth story.
Exactly. The balance sheet is a fortress compared to where it was just 18 months ago.
Okay, let's pivot away from the spreadsheet and look at the real world.
Hmm.
Where is this technology actually living? Because we can talk about ARR and margins all day, but at the end of the day, the product has to work in the real world and people have to want to buy it.
Absolutely. And the use cases are very specific. And frankly, the adoption curve is being driven by the unfortunate reality of American life today. The biggest sector for them, by far, is education.
Schools.
Yes. Evolv is deployed in over 1,300 school buildings now. They serve 22 of the 100 largest school districts in the United States.
And we saw a massive win recently with Gwinnett County Public Schools in Georgia.
The largest contract in company history, over 250 units. Gwinnett is a major district, and that deal sends a signal to every other superintendent in the country.
And this isn't just security theater to make parents feel better. The data shows these systems are active and working.
It is chilling, but yes. On the earnings call, the CEO mentioned, just as a matter of fact, that they have confirmed reports of system intercepting loaded handguns at schools in Nashville, in Georgia, and in Atlanta just in the last few months.
It's terrifying to think about, but it proves the utility. The AI found the gun in the backpack, the security team intervened, and a potential tragedy was prevented. That's a powerful sales pitch.
It is, and crucially, it's doing it without making the school feel like a prison. You don't have lines of kids taking off belts and shoes and feeling like you're going through a TSA checkpoint every morning.
That balance safety versus environment is why principals and superintendents are buying this.
Then you have the other big vertical, sports and entertainment. This is sort of the glamour side of the business.
The fun stuff.
The fun stuff. They have nearly 100 professional teams across the NFL, MLB, NHL, and NBA. If you go to a major league game, there's a very high probability you are walking through an Evolv system.
And they're seeing renewals, which is key. The Buffalo Sabres upgraded to the Gen 2 system. The Carolina Panthers at Bank of America Stadium renewed their contract. UNC Chapel Hill signed on.
The renewals are the key indicator. It proves that once a stadium installs this, they do not want to go back to old-school metal detectors. The throughput speed is addictive for venue operators.
A bit better fan experience.
It's a better fan experience, and there's a hidden ROI. Faster lines mean fans get into the venue sooner, which means they buy more beer and more hot dogs.
I never thought of that.
Yeah.
It's not just security, it's concession revenue. If I spend 20 minutes in the security line, that's 20 minutes I'm not standing in line to buy a $15 beer.
Exactly. But here's the stat that I think is the real mic drop of this entire report, the most telling piece of data we have.
Okay.
We mentioned earlier that the FTC settlement required Evolv to let certain customers cancel their contracts penalty-free.
Right. Because of the dispute over marketing claims, the FTC effectively said, if these schools feel they were misled by your ads, you have to let them leave. Evolv had to write a letter to 65 education customers offering them a get-out-of-jail-free card.
Now, put yourself in the shoes of a school board president. You have budget cuts. You have negative headlines about an FTC investigation. You have a free pass to cancel $1 million contract and get that money back in your budget.
You'd expect a mass exodus, right?
I would expect at least 20 or 30% to bail, maybe more. Why would you take the risk?
So what actually happened?
92% of the eligible customers elected to stay.
92%.
92. Only 5 customers canceled. And those 5 customers represented less than $500,000 in annual recurring revenue. A tiny fraction.
That is incredible. That speaks volumes more than any press release ever could.
It is the ultimate validation. Customers vote with their wallets, and when given a free chance to walk away, they overwhelmingly chose to stay.
It says the utility of the product, keeping guns out and keeping lines moving, outweighed any controversy.
They didn't care about the precise legal wording of a marketing brochure from 2 years ago. They cared that the machine in their lobby was working and making their students safer.
That proves the product is sticky. Once it's in, it stays in.
And sticky products create sticky, high-margin recurring revenue. That's the entire foundation of the Griffonomics thesis.
Okay, we've been pretty positive so far, and the story is compelling. But let's play devil's advocate. It's not all sunshine and rainbows. There are risks here.
There are always risks. And right now, the biggest operational risk is a company you probably haven't heard of called Plexus.
Plexus Corp. This is their new manufacturing partner, right?
Yes. As part of this whole move to direct fulfillment, Evolv is switching from their old manufacturing partner to Plexus to scale production and eventually lower their cost of goods.
Moving a complex hardware supply chain is like trying to do a heart transplant while running a marathon.
That is a great analogy. It is non-trivial. Transitions are messy. There's significant execution risk here. If Plexus hiccups, if there are delays in getting the new manufacturing lines up and running, Evolv could miss its revenue targets in 2026.
They're trying to grow 30% plus while swapping out the engine of the car.
Yes. If they can't ship the units, they can't book the ARR. It's that simple. So we need to watch their inventory levels and shipping times very closely in the first half of 2026. This is where the execution risk truly lies.
And then there's the valuation. Evolv is not a cheap stock. This turnaround story seems to be getting priced in already.
No, it is not cheap. It is trading at roughly 8.3 times trailing revenue.
For context, how does that compare to the rest of the security tech industry?
A standard comp would be a company like OSI Systems. They do airport scanners, cargo screening. They are the old guard of the industry.
Okay.
OSI trades at about 2.5 times revenue.
So Evolv is more than 3 times as expensive as the legacy players.
It is. Evolv is priced for perfection. There's not a lot of room for error at this valuation.
So why the premium? What are investors paying for?
Two things: growth and AI. Evolv is forecasting 37% to 40% growth for 2025. The legacy players like OSI are growing in the single digits, maybe low double digits on a good year.
And the AI narrative.
And the AI narrative. Investors are betting that Evolv is a technology platform with a software-like moat, not just another hardware manufacturer. If they miss that growth target, or if the margin story doesn't improve as promised, that multiple will contract very quickly and the stock will drop.
So let's wrap this up with a verdict. We've looked at the tech, the regulatory clearance, the financial pivot, the market adoption, and the risks. Where do we land on Evolv?
The zero scenario is gone. That's the most important takeaway. The bankruptcy risk that terrified investors in 2024 has completely evaporated. The regulatory firestorm is cleared.
So it's a green light, full speed ahead.
It's a yellow light turning to green light. It is now a pure execution play. The strategy is sound. The pivot to direct sales makes mathematical sense for the long term, but they have to actually do it.
They have to land the plane.
They have to land the plane. They have to manage the margin compression, navigate this tricky Plexus transition without a hitch, and hit that 20% plus ARR growth target in 2026.
So if we had to put a rating on it, it's a BUY, but with a high-risk qualifier. Or maybe a hold if you don't like volatility.
That's a perfect way to put it. If you believe in the J-curve and the power of their data moat, it's a buy. If you want to wait and see if the margins actually recover and the Plexus transition goes smoothly, you hold.
So let's summarize what we've learned today on this edition of Griffonomics. Evolv is pivoting from a high-margin, low-control hardware distributor to a lower-margin, high-control direct subscription business.
Right. They're trading margin percentage for absolute dollars and customer ownership.
The financials are stabilizing with positive EBITDA and a strong cash position. Their moat, built on the Safety Act and their massive data advantage, is intact and, you could argue, stronger than ever, proven by that incredible 92% retention rate.
And the market demand for weapons detection, unfortunately, isn't going away anytime soon. It's a secular tailwind.
Which leaves us with a final provocative thought. We talk so much about AI in this industry. Is it hype? Is it reality? Is it just a buzzword to get higher stock multiple?
It's the question everyone's asking about every company.
But in Evolv's case, the AI is literally finding guns in backpacks while keeping the line moving at a football game. The question isn't, does the tech work? As you said, customers have voted yes with their wallets and their renewals.
Right. The product market fit is clearly there.
The real question is, can the management team survive their own ambitious business model overhaul? It's one thing to build a great machine. It's a whole other thing to rebuild the entire company while it's flying at 30,000 feet.
That is the billion-dollar question for 2026. Can they execute?
And we will be watching. That's it for this special edition of The Deep Dive. Thanks for listening, and stay safe out there.
Risk defined. Portfolio protected.